Good morning and welcome to this Monday, October 17th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it's been a while since I've done Trading Places Live here at EarningsBeats, so I want to welcome everybody back. Appreciate your patience. We had a great trip out to Redmond, Washington for ChartCon. It was a blast getting back together with everybody. It had been 4 years. We had speakers come into ChartCon from all over the world. Some really good friends of mine. I met a few new folks, including Larry Williams, also Ralph Acampora. Just an absolutely great event. It's always great to get together with other like-minded individuals who not only are great technicians, but also very familiar with the stock charts platform. So getting together, seeing how everyone uses the platform also is a huge benefit as well. But we got a lot to talk about here with the market. I do want to let everybody know we have an event later today at 4:30, Q3 earnings sneak preview. Earnings started coming out on Friday. We saw JP Morgan come out, beat estimates, and we've got some other banks out this morning. I know Bank of America beat its earnings estimate. So banks getting off to a pretty good start. They had a really nice rally at the end of last week, even though the market was all over the place. Financials actually did really well, and many of the banks had a solid week, although didn't quite end with the kind of candlesticks we'd like to see on Friday. But otherwise, it was a pretty good week there. Let me go ahead and get everything set up here and we'll get started. I just wanted to get, we do these upcoming earnings chart lists, and there was one. Let me just make sure I've got it here. Yeah, I don't see it. I know I had it in here somewhere. Yeah, I'm going to have to probably just go over those individually because I thought I had it in this chart in this account, but I don't. Anyway, let me go ahead and pull everything up for you, and we'll get everything started here. Okay, should have my screen up now. And this was the Q3 earnings sneak preview that I was talking about at 4:30 today. So what I'm going to do is go in and take a look at upcoming earnings reports and just give you my thoughts on primarily this week, what looks good, what doesn't look good in terms of relative strength. That's what I use primarily as I head toward earnings season. I really want to see which companies are being treated the best in terms of their relative strength versus their peers, versus the S&P 500, and see how their individual industry groups are also performing versus the S&P 500, because we really want to have leading stocks and leading industry groups. Going into earnings reports, I would be extremely careful with companies that are showing very weak relative strength or relative weakness, not only versus their industry group, but also versus the S&P, and also within industry groups that are weak relative to the S&P. So at tonight's event, or this afternoon's event at 4:30 Eastern, I will be going over some of those. This is a free event for anyone. I would highly encourage you to stop by if you haven't seen this before, or even if you have seen it before. We obviously have updated charts and updated earnings reports that are going to be released this week that we want to go over. But I think it's fascinating, not only to look at the relative strength or weakness heading into earnings, but also to see how they report. And to me, it's amazing. Sometimes you get these companies that are, have been downtrending relative to the market. And then they come out with their earnings report and you find out why they've been downtrending for so long. I think one of the groups that I think is probably the most intriguing heading into earnings is semiconductors, because they have been so weak. I mean, software probably not far behind, but those are growth oriented companies. We want to see how, not only how they're doing, but how the market reacts to their reports. I suspect many of them are going to fall short of estimates or have something negative to say about the next quarter. You don't go down as much as these semiconductors have been going down without reason. So anyway, going to be talking about a lot of this later today. We'll send out room instructions later today to anyone who is on our EB Digest subscriber list. Also, of course, all of our members at EarningsBeats, you'll get the invite as well. And so hope to have a pretty big crowd later today. So if you'd like to join us, again, that'll be at 4:30. We'll get those instructions sent out. And anybody who's new, by the way, you can always go in and sign up to for our EarningsBeats Digest newsletter. Name and email address is all it takes. No credit card required. You can unsubscribe at any time. Honestly, I do this to give back to the community, things I've learned over the years. Sometimes it's just basic technical analysis. Maybe it's a divergence. Maybe it's a trend line, moving average test. Could be anything like that. It could be candlesticks, you know, the significance of individual candlesticks or patterns. It could be price volume, breakouts, breakdowns. There's just a myriad of different things that I would talk about there. But it is free. It's an opportunity for us to give back and hopefully teach folks some of the things I've learned over the years. So that's the whole idea. Make sure you are subscribed there. Okay, let's move on. Take a look at what happened on Friday. I'll be honest. I was shocked by the action on Friday. I was really surprised with the huge recovery on Thursday that we would go back down on Friday. All is not lost because we didn't lose the opening price action from Thursday when we had the hotter than expected CPI report out. So that was a good thing that we didn't go back and take that low out. So I'm not ready to throw in the towel as far as that reversing candlestick goes, but I was looking for continuation. We got a gap up on Friday and then we saw selling all day long, which is not what I would have anticipated after Thursday's rally. But hey, the market throws us curveballs and hopefully we can hit something other than fastballs. The Dow Jones Industrial Average finished down 404 points, the S&P down 87, NASDAQ down 327 points, mid caps down 57, small caps down 25. On a percentage basis, the Dow was the relative winner, dropping just 1 1/3%. But you can see the NASDAQ dropped over 3% on Friday. And if I'm being honest, the one thing I didn't like when you look at Thursday and Friday combined is that the NASDAQ really didn't do that much better, if at all, on Thursday. But then on Friday, when the selling kicked in, it was much worse. Now, it's only a 2-day sample, but I do like to see how the NASDAQ performs relative to the S&P 500. That's one of my sustainability ratios. That broke down on Friday. It actually went below the May low. So as I look at all my sustainability ratios, one of them has now broken back down below the May low. As more and more breakdown, or if more and more breakdown, that to me is a much, much more bearish signal than just simply the S&P 500 falling. The top formed when the rotation occurred into more aggressive area, or excuse me, out of the more aggressive areas and into more defensive areas. And I suspected, and I talked about at the beginning of the year, I thought the bottom would go in when the opposite occurred, when we started seeing money rotating into more aggressive areas. And that's really what we've seen since that May bottom. That's why I've been much, much more bullish, feeling that, hey, we're at a bottom, or, you know, now that the bottoms that I've called in the past have been taken out, I think we're very near a bottom. I don't know if Thursday's low was the bottom. We're going to find out probably this week. But it is max pain week. This is option expiration week. And I can only tell you there are a ton of in the money. There's a ton of in the money puts. And the money is off the charts. We're going to talk about that tomorrow. We have another webinar coming up tomorrow at 4:30. And that one is members only. But I think it's one of the most significant if you're a trader, because money talks. And market makers, I've said before, if they could sell a family member for $1, if I was a family member, I'd be worried, because they'll do anything for profit. And so knowing that there's a lot of incentive for market makers to put their capital to work this week just adds to the bullish anticipation. I don't know what the right word is, but I'm thinking that we're going to have a good week this week. Futures were good. I didn't even go over futures. Let me give you those numbers. So this was as of about 10 minutes ago. Dow futures are up 355 points this morning. S&P up 54. NASDAQ up 208. So on a percentage basis, NASDAQ doing really well today, up almost 2% futures. Now, this is delayed, what I'm looking at 10 minutes ago. But I would be surprised if it gives up all that in the next 20 minutes. Anyhow, oil prices up about 1% this morning. 10-year Treasury yield, and this is probably why we're seeing more of a pop in the NASDAQ shares. 10-year Treasury yield down 8 basis points this morning to 3.92%. Partly because of the Empire State Manufacturing Report, which came in worse than expected. The stock market, I know sometimes it makes no sense, but the stock market wants bad news right now. It wants bad economic news. That's what the Fed wants. The Fed wants to kill demand. Even if it's just temporary, the Fed wants to kill demand to snuff out inflation. And so the stock market is just waiting for bad economic reports. We got one this morning, and we'll see whether or not we continue to get those. But if we get those, then we're going to see the 10-year Treasury yield come down. And if the 10-year Treasury yield comes down, that should send the S&P and NASDAQ and Dow and all the major indices higher, with relative strength coming in the form of the NASDAQ, assuming rates continue to drop. So that's clearly going to be one thing we want to keep an eye on and watch. All right, but the volatility has just been extreme here over the last couple of weeks with the inflation, with the Fed meeting. We got another Fed meeting in November. Everybody's talking about another 75 basis point rate hike. Listen, the market's baked in a lot of bad news. And I know everyone thinks, or a lot of folks think, hey, market's got to go lower. We got inflation worries. We got interest rates going up. The Fed, continuing to tighten. It's, this is bad, possible recession. I think, based on old standards, we've already had one because we've had 2 straight quarters of negative GDP. But now the government says, no, we'll tell you when there's a recession. I don't call it whatever you want. We've slowed down. We've got higher interest rates. The market was down, I think I calculated over the weekend, 25.3 or 25.8% since the January 3rd closing high. That's the 9th worst bear market since 1950. So I know things are bad, and I know everybody thinks, hey, the market has to go lower. Just remember, a lot of stuff has been priced in so far. Doesn't mean we can't go lower, but based on the fact we're already down 25%, NASDAQ's down even more. I didn't do the calculation on the NASDAQ, but that's well over 30%. That's a lot. That prices in a lot of bad stuff. Maybe it hasn't priced all of it in yet. We're going to find out, but it's priced in a lot. History tells us when you're down 25%, it's generally a good idea to buy, not sell. I mean, I've studied history. I know it doesn't feel right. The market stinks. The economic reports, everything coming out stinks. Mortgages, are declining. Now, all of a sudden, housing, which was doing so well for a while, not struggling, but certainly weakening from where it was. I know nothing feels good, but the market prices these things in, and we've gone down a lot. Just keep that in mind. Anyway, sectors on Friday. Healthcare. Healthcare has really done well. Healthcare, whether you know it or not, is at an all-time relative high, which means its representation on the S&P 500 has never been higher than it is right now. So healthcare, if you're looking for areas that are doing well, now you look at the healthcare chart and you say, well, what, this is impossible. It's going down. I'm not talking about absolute strength or weakness. I'm talking about relative. Yes, it's going down, but it's going down much slower than the S&P 500. Look at the S&P taking out the lows from June. Do you see healthcare? Still above those June lows. So we're talking about relative strength. Healthcare has been the best. Well, throw energy in there. Energy and healthcare have been the two best groups over the last month, 3 months. Energy certainly for the year, but healthcare is strengthening, and money has been rotating into that area. So if you're looking for places to trade on the long side, healthcare has been much better than discretionary or technology. And I've said this to members recently quite a bit, but when I'm trying to catch a bottom like this, I almost always trade ETFs, not individual stocks. And the reason is, if I'm wrong, some of these individual stocks, these growth stocks, can get absolutely crushed. And I don't have to point to anything past the semiconductors or software stocks. And you should know exactly what I'm talking about. These stocks have been bludgeoned. And just when you think you have a bottom, they get hit even harder. So personally, I like to stick with ETFs until I begin to feel like the market has righted itself and we're in an uptrend. And then I want to begin looking at individual stocks again, because I think the upside there is phenomenal, but we're not at that point yet. Anyhow, healthcare had a good day on a relative basis Friday, only losing 0.2%. Not so good, however, was discretionary, losing 3.7%. By the way, last week, discretionary versus staples, that's another one of my ratios I like to watch, XLY versus XLP. That ratio took a big hit last week. Still above the May low, so nothing yet there to worry about. But last week was not good. The rotation, and we have to keep an eye on that. If it breaks down, not going to be a good thing for the market. Energy down 3.73%, right on discretionary's heels. Materials, technology, both down as well, struggling. Those were the next in line in terms of weak performance on Friday. Moving on to the 10-year Treasury yield. As I mentioned, we did have the Empire State Manufacturing number come out this morning. I think it came in at -9, and it was expected. Let me see if I can get that for you. I saw it, but I didn't write it down. It came in at -9, and I thought the expectation was -2, but I might be making that up. Let's see, -9.1 was the actual. Consensus is -2.5. And this, by the way, this is a monthly survey of manufacturers in New York. So the participants, they go to participants from across the state, which represent a variety of different industries. And so they take the same pool of, I think it's about 200, maybe 250, I don't remember the number, of manufacturing executives, which normally is like the president or the CEO. And they just get a questionnaire. They report on the change in various indicators from the previous month. So it's a pretty good sense, at least in the state of New York, of economic conditions. And anything that's negative is not good, obviously. Anything positive is good, more bullish. And so the estimate was -2.5. It came in at -9.1. So I don't know if that's the reason why we're seeing yields down, but it could be at least partly responsible. You can see right now, 10-year Treasury yield back down to 3.92%. On the breakout on Friday, by the way, we closed above 4%, which took out that high from September. But look at the negative divergence now on the daily chart. I talked about the weekly chart. If we look at a 5-year weekly chart, this high right here versus the prior high, negative divergence. And then as we kept breaking out, moving up, we're still in a negative divergence. The weekly PPO is moving higher, but it seems to be stalling here with another negative divergence. So we've got negative divergences on the 10-year Treasury yield on both the daily and weekly charts, showing slowing momentum to the upside. If the 10-year Treasury yield pulls back, that would be a very big catalyst for the stock market to move higher. Watch that this week. Yield comes down. That could set the equity market on fire, especially during option expiration week. All right, let's move on. Talking technically. Wanted first just to go over the S&P 500. You can see the failure at the 20-day back in October. At that time, we had moved down to this low, and when we had rallied back. And so normally when you rally back with the PPO at the low on the most recent price low, that rally normally fails at the 20-day. But when we go back down, we set a new low and we have a higher PPO and we get a positive divergence. That's telling me that the odds have grown. Not that we've got a guarantee, but the odds have grown that we're going to move back up and take out the 20-day and potentially move to the 50-day. So I actually think on this next move, and we'll see whether or not it's long-term move, and we'll see if it actually even comes to fruition. But I wouldn't be surprised to see a move to 3,900 on the S&P. Only because that's what a positive divergence tells me, not because I'm just set in my bullish ways, which many of you might think. And I am to some extent. But that's what the positive divergence tells me. Here on this daily chart, positive divergence tells me don't look just for resistance at the 20-day. Look for a reset of the PPO back to the center line and a possible 50-day test. I mean, if you look back in May, looks like we had a slight positive divergence. I know we had a lower close, and it looks like PPO may have been higher. But look at the rally. Look at us get back close to the center line, and then we go to a new low. But the 20-day didn't stop us here. See how the 20-day was stopping us as the PPO was going down? Each time we'd go to a low, the PPO was lower. We'd bounce, we'd fail at the 20. We'd go down, new low, we'd fail at the 20. Come back down. Now we got a positive divergence, slight one, as it may have been. And then we rally through the 20. Here, got through the 20 a little bit there, quickly right back down below. Here, PPO pointing lower at the most recent low. We rally, 20-day fails, go back down to a new low. Positive divergence is much clearer here. And so if we can get back through the 20, which is 3,700, that's the 20-day, 3,710 actually. I think 3,900 could be in the cards. And we already know that's a significant pivot area on the market for on the S&P 500 for the last several months. Multiple tests and failures around that 3,900 level. 50-day is falling and at 3,933. So if we get the 3,900, and I'm just saying if, that 50-day moving average is also going to be overhead resistance, in addition to all the price resistance that we've encountered. Or support. I mean, we encountered support at 3,900 prior to breaking down. Then it's been resistance. Here was support. Here was support. Here was resistance. 3,900 is a big level. So keep this in mind. All right, so let's take a look at the S&P 500. And I showed you the daily chart, showed you the positive divergence on the daily chart right here. Let's look at the weekly chart. Because we now have a lower low here with a higher PPO. So we have a positive divergence on the weekly chart, which in turn would suggest maybe a 50-week test and a PPO centerline test. That means right now 50-week is over 4,200. So the weekly chart is actually pointing a little bit higher. Now, I will say this, when I look at divergences, I don't like them as much when you get a move all the way back up to the 50 period instead of just the 20. Because usually you get to the 50, you get the PPO up near the center line. It's almost like you have a reset and you're kind of starting over again. So whether or not you consider this a positive divergence or not, I don't know. I will say that on Thursday, this weekly candle looked really bullish. And then we had the big down day on Friday. Doesn't look as bullish as it did on Thursday. And if I pull up this weekly chart and let's just do this select start date. And if I do 2022, 10:13, which would be Thursday's close. Look at that candlestick, that weekly candle. I mean, I was ready to declare another market bottom based on that candlestick. Then we had the week Friday, and ended up, obviously not looking nearly as strong. But that positive divergence with a weekly reversal on the candle, that combination normally is pretty powerful. All right, what else do I have? And just keep in mind, these divergences are like any other technical indicator. They're there to help us manage risk, not to provide us a guarantee. I say it all the time, but it's really important. I use it to manage risk. And if I see a positive divergence and that's all I see, that's bullish, and everything else I'm looking at is bearish, I'm probably going to be a little bit more cautious with that one bullish signal. However, this is now showing up. These positive divergences are now showing up with other bullish signals. We've reset sentiment. The equity only put call ratio now is much, much higher. We could pull that up. If I go out just a few years, these are the daily readings. But look at the daily reading. That was back in the pandemic. So obviously there was a lot of fear. Everybody buying puts back then. We got too fearful. But then we came back down. Look at 2020 and 2021. Look at all of these readings down here at 0.4, many in the 0.3s. Excuse me. Lots of readings in the 0.3s, 0.4s to 0.5s. And you might think, well, that's just, looks like the average during this period. And it is, except let's drag this back even further now. Let's go 10 years. And I want you to see how crazy bullish we got in 2020 and 2021. This was all part of a secular bull market. We had few readings below 0.50 until 2020 and 2021. And then it was almost standard to have these readings. And a put call ratio, if you're not familiar with it, below 0.50 simply means that there are not many puts being traded relative to calls. A lot more emphasis on calls being traded. And most calls are being bought. There are some calls that are sold to open, but most, those are more professionals, maybe some seasoned options traders. Most retail traders are buying puts or buying calls. And so when you see all of these calls being bought relative to puts, it just tells you the market that almost all the buyers that are out there have bought. And that was crazy bullish sentiment readings, suggesting the market was incredibly complacent. And if we go back to that S&P 500 chart and we look at the weekly chart, look at the divergence on the weekly chart as we ended the year. Look at this weekly PPO the last 6, 7, 8 months of the year. Every time we went up, lower PPO. So that's what I mean by combining a lot of indicators and not just relying on one here, one there. To me, the market is a great big jigsaw puzzle. And you got to look at all the pieces. You can't take 1,000-piece jigsaw puzzle, put 3 of them together, and think you've got something. You can't figure out what the puzzle is based on that. But if you put 600 or 700 of the pieces together, you might start to get an image. And that's kind of what looking at the market is. It's about putting as many pieces together as you can and developing a picture in your mind of what this is telling. Not listening to CNBC. They're never going to tell you any of this stuff. They're trying to sell ads. They just want you to view. They're going to show you the train wreck, talk to you about inflation, higher rates. Oh, this is awful. This is the worst it's ever been. Bring Peter Schiff on. Yeah, let's, throw the kitchen sink in here and scare everybody to death. Let's get them out of their money. Meanwhile, by the way, I'm going to be doing a manipulation event coming up in a few weeks. And I'm going to talk about how Wall Street right now is accumulating shares while everyone else is selling. mean, it's unfortunate, but it is what it is. Anyhow, so I wanted to show you that those divergences do matter. And so now we do have one at the bottom. Normally markets go up much more boringly than they go down. When they go down, they tend to go down really fast and scare everyone. I mean, you can see it on the chart just here over the last 5 years. 2018, there's the trade war in 2018. That was a bear market 3 months. Here was a bear market 1 month. And now this is a little bit more of the normal cyclical bear market variety. And again, I know a lot of folks out there, a lot of you probably listening, believe that this is a secular bear market and we're going to go a lot lower. And maybe it is. Maybe you'll be right. I don't believe it is. And we'll see. But this is more normal cyclical bear market, 6 to 9 months, 20, 25%, maybe, 20 to 30%. There are some others that go a little bit deeper. We'll see whether or not this one goes further. And actually, we're 25% right now based on, I think, the close, I believe. Yeah, I think it was the close. So if you go back down to the intraday low back on Thursday, when that PPI report came out, it actually was much higher. So probably we were down around 27, 28%, I guess, at that low. All right. So earnings, let's just take a quick look. Market just opened. So I'll give you this Bank of America. There's the Bank of America reaction. And JP Morgan was a stock that I provided last Wednesday in the EB Digest. It was in this downtrend. And literally from here, I drew a line up to the 50-day and just simply said, hey, JP Morgan looks like it's poised potentially for a move back to the upside. Positive divergence. There's your 50-day. By the way, that was a reversing candle on Friday, a shooting star. So we had reversing candles on Thursday because we had that big reversal and move to the upside, and the market seemed to ignore it on Friday. Well, Friday, look at the shooting star candle on JP Morgan at the 50-day. We ignored it, just went right back up again. So, market is volatile. Trading is crazy. Individual stocks. I mean, if anything, I would have shorted JP Morgan on Friday. If you told me I had to take a position on Friday, looking at that candle, I would have shorted. And the stock's up $5 this morning. Again, that's why I'm looking at ETFs right now. I just find the volatility very difficult to predict. And yes, if you're right, you can make a lot of money. But for me, capital preservation is the most important thing. And it's just hard to manage risk with individual stocks right now. Anyhow, let's take a quick look at the market and then we will wrap up. So we got the Dow Jones up 562 points. So everything that happened on Friday, gone. So everything happened on Thursday was pretty much gone on Friday, or at least a good portion of it. And now all of a sudden, Friday's weakness is gone. And here we are right back up again. One thing that was interesting was the VIX. I don't know if you were watching the VIX last week. Let me look at that chart and then we'll end this. I want to just look at the 5-day. So remember, on Thursday, right here, this is when we had the huge gap down and the S&P went down under 3,500. Look at what the VIX did. The VIX, when the market's going down, volatility normally spikes up. The VIX barely even went up with a horrible inflation report, awful reaction. The VIX was up maybe 0.5%, or maybe it was up 1%. And look what it did. Rest of the day down. And then even on Friday, we saw all that selling on Friday, and we finished on Friday on the VIX almost right where we started. It's almost like the fear has been wrung out of the market, at least according to the VIX. Sentiment has reset on the CPCE, equity only put call ratio. These are really positive signals. I can't tell you what the market's going to do with certainty, but based on history and based on all the signals I'm seeing, I am still bullish. And maybe it'll prove to be the wrong call, but I just speak what I see on the charts. Anyhow, that's all I have for today. I appreciate you tuning in. Thanks for the patience, by the way, for the last week to 10 days while we did ChartCon. I know a lot of things, especially members, EarningsBeats members. I didn't send out the weekly portfolio report last Sunday. I started to work on it midweek. I was going to send it out, and then I got caught up in trying to catch up with the other chart list. Anyway, that didn't go out until last night. Hopefully this week we'll get everything back, in gear and be back on time with everything. So again, I appreciate members' patience as well. All right, I'll be back over at Stock Charts TV tomorrow for your next Trading Places Live. Just click on the Stock Charts TV at the top of the Stock Charts page there. You don't have to be a member of Stock Charts. You can come right in, listen. 9 a.m. Eastern. You can get me there on Tuesdays and Thursdays. Again, 4:30 today, sneak preview of Q3 earnings. It's going to be a fun event. Tomorrow, Max Payne. And then Wednesday, we've got our draft. We're going to be drafting our ETFs for our model ETF portfolio. So it's going to be a busy week for us here at EarningsBeats. Hope you can join us for all of those events. Everybody have a great day. Happy trading.